David, you're muted.
Sorry, I apologise for that, guys. I was muted before you went in. Sorry. I was going to say thank you all for attending our presentation of Henderson European Focus Trust. We are joined by manager Tom O'Hara, co-manager Tom O'Hara. Henderson European Focus Trust has long been a stalwart of what you would consider a more balanced approach to European equities, with part of the team's investment DNA essentially being to avoid a structure of biases of sort of growth and value and insulate their shareholders from the sort of valuation extremes and the reaction to them that you can occasionally get, and is a fact which has become particularly prominent in our opinion given recent market dynamics. This is also, of course, on top of having a genuinely nuanced and considered, if not slightly unconventional view around ESG. But I'm not going to steal any more of Tom's thunder. As always, we invite everyone watching to submit questions on the right-hand side in the Q&A tab. And upon Tom completing his presentation, we'll begin to address them in a short discussion afterwards. So without any further ado, I pass over to you, Tom.
Thank you, David. Hi, everyone. I'm Tom O'Hara. I'm a co-manager, along with John Bennett, of the Henderson European Focus Trust, or HEFT for short, as I'll refer to it from now on. HEFT is a focused portfolio of 35 to 45, so maximum 45 stocks, European listed. And these are stocks that we consider to be the best idiosyncratic opportunities in Europe. We have a style agnostic investment approach, so we really care about the price that we pay for an asset. We don't buy fashionable growth stocks at any price, that's for sure. But nor do we simply scour the market looking for the cheapest stocks, because that's value trap territory. We do see ourselves as a blend fund, and that means that we're a fund that should weather all investment seasons quite well. HEFT is focused on total return, not income specifically, but nonetheless, HEFT currently offers about 2.5% dividend yield. So it's well worth bearing in mind in the context of today's topic, which is ideas for your ISA. Now, at this moment in time, many of you may regard the prospect or your response to the proposition of would you like some European equities in the same way that you might welcome the prospect of a mild to moderate case of COVID. It's fair to say that Europe's outlook is more cloudy than the safe haven of the US, for example. Europe's proximity to the war zone, its greater energy and commodity dependence on Russia and Ukraine does bring added risks. But I'm going to outline a few thoughts on where I think we go from here and why strong, unconstrained, valuation-conscious European stock picking offers strong potential into what I think is actually a new investing era. So if we go to my first slide, this is a slide that's been in our slide deck for a couple of years now. And the main conclusion of this, in my view, is that the era of easy money and sexy stock markets, I'm sure we've all had friends that all of a sudden during COVID wanted to know everything about markets and were putting money all over the place in Tesla and cryptocurrencies and SPACs and whatnot. That era is done, I think. And this slide, as I said, has been in our presentation deck for 2 years now. COVID ushered in the end of austerity. It ushered in increased state intervention. That's growing every day, we can see that. And it ushered in the prospect of higher inflation. Now, the Russian invasion of Ukraine, which I'm sure we'll get onto in the Q&A in detail, that just accelerates this. Europe gets 40% of its gas from Europe. Germany gets 40% of its aluminium from Russia. So I just realized I said Europe gets 40% of its gas from Europe. It gets 40% of its gas from Russia. Germany also gets 20% of its steel from Russia. 20% of rapeseed comes from Ukraine. And there'll be no spring planting season there this year. So there are major economic dislocations that will force inflation higher and higher. That's really important for the investment paradigm that I think we're going into. Now, the next slide I'd like to show you is something David alluded to it, and he said, possibly, I believe, it's even a slightly controversial view on ESG, but the thing I would like to say about ESG at this point in time is that I think what we've seen over the last couple of years is dogmatic ESG. And I think dogmatic ESG is dead. So long live pragmatic ESG. And for a couple of years now, John and I and the rest of the team have kind of looked on in horror at the narrative that's taken shape in financial markets, in the wider public discourse. And that's been the absolute lunacy of ESG so far. So we've been cancelling responsible Western operators simply on the basis of their current carbon emissions. And the disastrous impact of that has really been laid bare by the war. So security of energy supply, and even of our entire way of life has been subordinated to binary, arrogant moral certainty. The war's been a reckoning, and it ushers in another paradigm shift, I think. What we've seen over recent years is fund managers cancelling entire sectors, inserting the word sustainable into their fund titles, and claiming to be doing good and outperforming, really because they are invested in a lot of growth stocks. So hopefully this period of lunacy is over now, and stock markets will start to take a more nuanced approach to ESG, and the requirement for an orderly energy transition that doesn't kill the consumer. I mean, and that's really, really topical right now. So in fact, I expect a lot of the sustainable funds to start changing their investment policies. One, because they've started to underperform, as sectors like oil lead the market and sexy tech stocks and the like, they underperform. And two, because as things stand, they've forbidden themselves from owning sectors which are actually critical tools for capital preservation during a period of heightened inflation. And in particular, if we go into a period of stagflation, well, a lot of that comes from upstream commodities. And if you can't own those because you said they're naughty, that's a real problem for your client. So we've always been open to owning commodity sectors. And actually, at the minute, we're quite substantially overweight in oil stocks and have been since 2020, because we believe they play a pivotal role in reducing global emissions and delivering that security of supply that I mentioned. Most importantly, though, the risk reward is attractive for our shareholders. So clients come first, not moral grandstanding. Now, when I put all this together, I'm going on to a slide here that shows broadly how we've navigated the pandemic and the shape of the portfolio today. But when I put together the fact that inflation changes things, that the ESG narrative, which really skewed valuations in the market, that's done. Those things combined, to me, mean that the price you pay for an asset matters again. So what goes out of fashion often comes back into fashion. And as valuation conscious investors, we've been out of fashion for a long time because we just could not bring ourselves to buy unprofitable story stocks in things like food delivery that will never make any money. And in fact, increasing numbers of them now look like they're going bust. The price you pay is extremely important. So I think valuation is coming back into fashion for the foreseeable future. I think the world has entered a new, more difficult era. Stock markets are going to be more difficult. It's going to be harder to make money. Alongside that, I believe value will outperform growth. I believe the era of buying tech stocks at any price is over. And as I mentioned, I think unprofitable, fashionable growth is essentially toast. Europe, in that context, sort of boring, old, dysfunctional Europe, actually has a lot of idiosyncratic opportunities. at much more palatable valuations. So what I think is this becomes a stock pickers market again. That's our bread and butter. And actually Europe, if you get beneath the surface, offers a really, really good fertile territory for valuation conscious stock picking. And that's worth considering in an ISA. Now, as you would expect, heft is the single biggest holding in my personal ISA savings. You would expect that, but also it's because I absolutely believe in what we're doing and the beauty of the trust structure. And so actually what I'd like to finish on is one of the really attractive attributes of the trust structure, and that is leverage. So alongside the obvious benefit of the trust structure, which is it's closed-ended, so we can be patient and we can invest in some of the more interesting mid-cap, small-cap opportunities that open-ended funds might struggle to because of liquidity considerations. We don't have to worry about that in the trust structure. So being closed-ended, of course, is wonderful. Leverage is something else that, done right, can be fantastic in value realization for shareholders. And that's what I'd like to wrap up with right now for the set part of the presentation, the ability to deploy gearing. So at the end of January, actually, we borrowed 30-year, very low-cost debt at about a weighted average coupon of 1.57%. We borrowed about 30 million sterling. That, at the time we borrowed it, was the potential to deploy gearing to 8% of our net asset value. Now, actually, we're quite conservative on leverage. So you do get a lot of trusts that are almost always allocated 10, 15% plus on leverage. We're less, or we've been less inclined to do that. What we've taken on in this low-cost, long-term debt is the ability to gear up towards about 8% of current net asset value. We haven't used it all yet. And from the following couple of weeks after we borrowed the money, things got a little bit shaky, of course, surrounding Russia and Ukraine. So we didn't use any of it. It was, in fact, only in recent weeks, as the crisis unfolded and as markets sold off, that we started to deploy that gearing and take advantage of opportunities in the market. And in fact, what we did, we topped up on a number of stocks, actually a lot of the materials, more cyclical stocks, where we felt the initial market reaction had been so extreme that they were already pricing European recession. So we topped up a number of those stocks. We're today about half deployed in that 30 million sterling. So we've still got another 15 million pounds that we're ready to deploy to realize greater value for our shareholders when we think the opportunities are there. And we'll do that. We'll take advantage of those opportunities as individual stocks perhaps come under further weakness during what could well be turbulent times ahead. So with that, I'm going to stop there and I'm going to welcome any questions you might have. I'm sure there are plenty, especially regarding current events.
Thank you very much for that presentation, Tom. I think speaking of present events, I think it is probably most poignant to start the questions off with something around Ukraine. I mean, no one wants to ever say they can get inside the mind of Putin, but how do you feel, I guess, the market reaction has genuinely been in Europe? Because we have seen a broad-based sell-off, with nonetheless growth stocks being particularly hammered relative, but still nonetheless a broad-based sell-off. How do you feel that this is? Where is it unjustified? Where do you sort of see opportunities in this, as you mentioned, in the context of gearing deployment? And how do you feel, I guess, is it too much for it short term, or do you think there's some long-term implications from the Ukrainian crisis within Europe, and how is your portfolio, I suppose, by extension, reacting?
Yeah, so there are a couple of things to unpick there, and I'll try and do them in the best order possible. The first thing that's been really obvious is outflows from Europe. That's been the first element of the market reaction. Europe's now a war zone. Outflows, we get various data sets from the investment banks and so on. It's quite obvious that Europe has seen really quite extreme outflows as an asset class in the last couple of weeks. And actually, there are a few interesting things to point to that really draw into focus just what impact that European risk-off has had. And the best sector to look at is, I've mentioned it already, is the oil sector. What we've seen over this period, with the exception of the last couple of days, is oil prices going up. As you might expect, that leads to positive earnings revisions for oil companies. US oil stocks have been going up. European oil stocks, even after a couple of the companies come out and say, we've impaired our Russian exposure, it's not that big in most cases, let's move on. Even after that point of impairment crystallization, those European oil stocks have not been performing as well as the European oils, as the US oil stocks. So that the outflow from Europe has pressured even those sectors that are seeing earnings upgrades in this environment. So that's the first thing. I think it probably does make global asset allocators more cautious about investing or allocating to Europe as a whole. We've got to concede that, and we've got to expect that to be something that will take a while to fix. Who knows how long this conflict drags on? Hopefully not very long, but even after that, there's going to be a period of rehabilitation required in terms of Europe's perception in the investment world. Now, the other issue that we have to contend with here is some of those things I mentioned on that first slide, which is this accelerates global dislocation, this accelerates deglobalization, state intervention, state protectionism of key strategic industries. I mean, just look at the response from Germany in recent weeks. After decades of hassling by NATO allies, Germany turns on a dime, increases defence budgets to 2%. It also looks into switching back on its coal power plants. It also looks into switching back on its nuclear power plants. It also looks at putting tariffs on imports of Russian steel into Europe. And as I mentioned earlier, Germany gets 20% of its steel from Russia. These are huge dislocations that have now been accelerated. It does present the risk of stagflation, and that's something we have to monitor, and that's something that John, myself, and the team are neurotic about every day. And stagflation requires a whole different mindset, and hopefully I've alluded to that through this presentation. You have to really start caring about the price you pay for assets and make sure you're in the right parts of the market. If your starting point is that you've cancelled sectors based on some very superficial moral framework, you're in a weak position to start with, because oil, gas, other commodities are going to be potentially very, very useful tools to preserve your client's capital in the face of potential stagflation. So the overall GDP economic outlook is less certain. Some of it is justified, of course, and in response to that, you know, as I said, people maybe do want to take a bit of money out of Europe. They maybe do want to go a bit more defensive into maybe some more US exposure, even if it's listed in Europe, food retail, anything that is perhaps less exposed to the disposable income hit that people are going to suffer as a result of higher energy prices and so on, and higher food prices. So some of it is justified, but what we've seen, even just in recent weeks, is the market has shot first in a very, very extreme fashion in a number of stocks. And ultimately, this is our job, isn't it? Our job is to pick out what's an unjustified sell-off in this environment and make sure that we take advantage of that sell-off. And that's what we've done. Where we've seen the most unjustified, unwarranted hit to stocks, it's actually been in some of the materials cyclicals names that we own. It's things like AkzoNobel Chemicals Company, Signify, the old Philips lighting business, Holcim Cement Company. These are things that are their value stocks got hit the hardest because that's always the place where risk off comes first. These things actually, Signify, for example, I think it was the beginning of last week, sold off 20% in 2 sessions. So we bought some more. It's now up 20% since then. So there's also an element of opportunity in all of this, which is the market does not know what it's doing right now. If you add on the fact that many of the volumes in stock markets are driven by short-term hedge fund money, which is geared up by 4 or 5 times, there's always a huge positioning shakeout in these events. Similarly, you get algorithmic trading and all sorts of things tracking baskets and factors. It's not real decision makers necessarily deciding that they want to take money out of the market. So that's the opportunity as well. David, was there anything else I missed on your question there that you want me to address? I think you might be on mute, or my laptop's a mess.
David, we've lost your sound.
Okay, so I think I can hear you now, David.
Okay. Is this better?
Yes, could you start that entire question again, please?
Sorry,
I was really
apologies
worried.
about everyone
I
on
was
my
worried
side.
it was my IT breaking down, but yeah, that would be great if you could repeat it. Thank you.
Yeah, it was just we had a question come in as you were commenting about Russia. So it's probably a bit more short term, but what would a peace deal between Russia and the Ukraine mean for European equity markets? Is there any sort of things that are very poised for a sudden rebound if the geopolitical risks are taken off the table?
Yeah, I think you get a huge rebound in European equities as indiscriminate on the way up as it was on the way down. I think that's the very first reaction. And we've already seen hints of that over the last week. I'm very skeptical. There are headlines 2 or 3 times a day. And I just think it's classic Russian subversion. But it's somebody in government says negotiations are going well and we will, we're edging closer in our agreements on, what we want to get out of this. And then somebody else in the Russian inner circle says we will realize all of our ambitions in the Ukraine. And in response to those headlines, you see the market gyrating around all over the place. So if you actually did get a firm peace deal, the first day or so, it really would be quite a dramatic bounce. The shape of that would favour value stocks again because they've been hit the hardest, and any other stocks that are seen as risky in their attributes. And I also didn't mention these specifically, but you can see them. If you can still see the slides, this slide I'm on here, this consumer V-shape, these reopening stocks, travel stocks, they're not all value stocks as such. Some of them were actually quite high multiple darlings before COVID, but they behave in a very, in a similar risk-off manner to sort of classic value stocks when the market gets jittery. Those are the things that will rebound very aggressively on a peace deal. Now, in the days and weeks following that, it's back to business, isn't it? It's sifting out what of that was justified, unjustified, which stocks haven't caught up yet, but actually are undervalued. That's when, again, our bread and butter work kicks in. But certainly, Europe's been impaired quite substantially at the moment. It has recovered from the lows of last week, but it's still being impaired and it's still poised for a bounce. If we do get that kind of very certain clean headline, then yeah, that's what I'd expect.
Couple of questions actually, taking the topic a bit off course in the Ukraine, looking at the underlying earnings. So you are a European equity fund, certainly. but what portion would you say the underlying revenue is derived from overseas? How much of it is domestic? And also a specific question is how much of these earnings emanate from China in particular?
So hopefully you can see this slide here. That shows our overall exposure in terms of aggregated revenues regionally from our underlying companies. Now, we are predominantly a large cap fund. So these are global companies. They may be born in Europe, but they're global champions in many cases. So it's not a complete reliance on Europe for revenues and profits. And as you can see here, we're actually fairly close to the benchmark in terms of our geographical spread of revenues. We're just over 40% developed Europe, with just over a third emerging markets, and then the remainder is North America. And of course, in that Asia emerging markets bucket, you do have some substantial countries like Australia, like Korea, and so on, but a big chunk of that is China. What's also worth mentioning is this is always a tricky, this sort of breakdown doesn't always give the full picture, because of course within Europe you have a number of global industrial champions that essentially sell their products to other European companies who in turn are serving their customers in China. So a big chunk of the developed Europe revenues, for example, will be those companies that are actually part of the supply chain to a Chinese company. So it's more intertwined than it looks on this slide.
Mm-hmm. Then I suppose in that case, then, do you find that regardless of the underlying revenue exposure, do people tend to just sort of bundle European companies together? Europe is sold off, everything is sold off, or are companies that are truly international, do they get a little bit more of a buffer?
On the whole, Europe tends to be treated with a broad brush by global asset allocators. So when we speak to our US clients, they want to know on the whole, what's the outlook for Europe? Why should we allocate outside of the US, which has been so fantastic for 10 years? And actually that level of interest in Europe was picking up very dramatically towards the end of last year, and certainly into the new year, as once we came into the new year, Omicron turned out to not be something to hugely worry about in terms of the economic reopening, and we had a really aggressive value rotation pretty much up until the war broke out. When you get a value rotation like that, that usually puts Europe into play, along with Japan. These are classic value construct territories. The nature of the benchmarks is more valuation or is more value heavy in terms of the stocks and the multiples they trade on, certainly relative to the US. So we saw people warming up to Europe, people who had a choice whether to invest in Europe or not, actually warming up to it. And then the war has very quickly made people go, I've got to get out of this for now and just see how things go. So that's where we are. There are some exceptions. There are some stocks, and it might be in the tech space, or it might be in, as I've already mentioned, that global ESG mandate. You get a lot of global ESG funds, and there are particular darlings in Europe. I'm thinking something like an ASML in the Netherlands. It's huge in market cap terms. It's a big part of the benchmark in Europe, but it's effectively a very unique asset, building equipment for semiconductor manufacturing. People globally want to own that stock. So that's one of the exceptions you'll get. And there are some others out there, but broadly speaking, initially it's a case of Europe, you're either in or you're either out. And over the last few weeks, a number of people have gone, we're out.
I guess being in and out of Europe, a great way to finish that question off, because another question from one of our audience members is, on a look-through basis, the fund doesn't necessarily have, I don't think it has, any exposure to Italy as a region. And their comment was, is there a view on the country by the team? I know you are bottom-up stock pickers, but is there a reason why you have zero allocation to one of Europe's largest economies?
No, and the reason is that the country of listing, particularly in our large cap sphere, is not necessarily indicative of the underlying economic exposure of the company. So we're quite heavy in French listed companies at the minute. We've got things like Airbus, EssilorLuxottica, Schneider Electric. They're not a French play. So it's really not something that we look closely at, because we're not investing in markets in order to gain exposure to that domestic economy as such, particularly in large cap land. So the fact that we have no Italian listed companies at this point in time is more just a side effect, or it's incidental.
Mm-hmm. Something I want to touch on is a personal question for me. There are a couple of others I want to get through, but in the peer group space, I'm not sure if our audience is aware, but recently the JP Morgan European Income Strategy was merged with this growth peer. This leaves Henderson Eurofocus as arguably, I think, for certain style metrics, the most value fund, if you can put it on a spectrum. And as I say, you are value, you mentioned you're essentially balanced core. But in a world where, on a peer group and a broader universe of investors, where value is slowly being choked out, I guess having a prolonged growth value can do that. I want to wonder, is that reflective of inherent quality of value stocks? Do you have growth stocks as a sector become essentially the more higher quality, the more earnings generative, or are there still just essentially other value darlings left? Can you people think that, okay, it's not a sexy industry, but fundamentally this company is as strong as anything else?
Yeah, no, it's a really good question, and I have some slides in here showing that we do pay up for growth. Top left there, you've actually got ASML that I mentioned as perhaps one of those European companies that gets a pass, and global asset allocators want it regardless of its territory of listing. We've called it franchise stocks here because compliance told us we weren't allowed to call them growth stocks, because that might be perceived as some sort of advice or forecast for their prospects or something. But what we mean is these are stocks with unique attributes, high barriers to entry due to scale or brand equity or IP. None of them are particularly cheap, but we do pay up for them. Likewise, we have value stocks here. And what we're often looking for is that something's changing. It can be new management teams blowing fresh wind through the company, restructuring. It could be that the sector has entered a new secular growth phase due to innovation, anything along those lines. These stocks on here have been very unpopular at some point in time, or you look over the last 10 years, many of them haven't had a bull market because they were seen as basket cases. But we sense something's changing. New management is usually fixing something in these businesses, and that's a really, really significant route to shareholder value creation. Cut costs, re-accelerate the top line, all of that stuff. So that should tell you that we're blend. When we look for value, we don't need to go basket case value. We can go quality value, or value with a catalyst. Again, it's all about stock picking. It's all about meeting the companies, and that's really one of the competitive advantages that I would say we have, is we meet the companies of the companies. So we meet the management teams of the companies we own, usually once a quarter, but at least twice a year. And we have a long list of companies that we don't own yet, but we're always keeping in touch with them, so that when we get that sign of something changing in the company, that can be a really good opportunity. Now, you mentioned effectively that we're really the only value guys in the peer group. And it's true. The fact that we're not out and out value really tells you something, doesn't it? Everybody has been one side of the boat because it's been a one-way road for the last 10 years. Everybody who was value either got sacked, or they got fed up and retired, or they had their road to Damascus moment and became growth managers. And there's not many value people left knocking about. And as I said, we're not out and out value. We're just probably much more valuation conscious than a lot of the peer group. But we will pay up for growth when we think that it's warranted by the unique attributes of that company.
Mm-hmm. And something I think not necessarily elephant in the room, but certainly what a lot of people may not be hearing from other people is your views on ESG. And I want to just touch on that a little bit more, if I can. Do you feel that this sell-off in ESG, is it a focus more on the dirty, gritty end, which people do tend to associate with the hyper-cyclicals? Or have you found stocks within that ESG bucket which you would have considered growth? You would have considered, I know you mentioned Holcim, and company does have phenomenal earnings previously, or strong earnings per share growth. I can remember throw my mind back that far. But has this been just a absolute slaughter of anything in an associated industry, or is it focused more on the deeper end of the sort of the value trappy spectrum?
In terms of
just the nature of the companies, you mentioned they're getting cancer, companies have been taken out of the market, becoming uninvestable. Is this just a blanket sale, or is it more focused on the sort of dirty value trap, the things that were essentially a subsequent decline? Or within there, are people just throwing out what prior to ESG would have been considered great companies?
Yes. So I take a cynical view of this. I read a really a very accurate quote that described ESG as growth plus virtue. And the opposite of that was you can sell the things that aren't growthy and are dirty. That was an easy way to get a pass to be described as an ESG fund. You have to show that you were doing something differently. So, you might screen the benchmark and go, right, highest emitters. And as you said, they are usually the more cyclical industries. They might be steel, cement, oil, gas, chemicals. Cancel those guys because they're dirty and they're value, and actually value's not been working that well anyway. So I don't care that they're cheap. They're trapped. They're value traps. That will change now because we were in an inflationary era where valuation matters, but also because it's already caused pain. So I've already talked about oil and gas. The thing that is rehabilitating oil and gas is, yes, it's because we've all realised that actually we'd rather get our fuel from BP, Shell, and Total than Vladimir Putin. And actually, these companies spend billions of dollars every year on renewable energy and other technological investments to enable an orderly energy transition. So we're in the process of uncancelling things now, and defence is the same. But it's been easy to cancel those sectors because they've not really worked. So it didn't necessarily require much of a sacrifice from a fund manager in what they deemed to be the investable universe in the first place. Oil and gas is a bugger to manage an exposure to because the top line can be volatile. Mining companies the same. But the era that we're in, more protectionism, shortage of commodities, valuation mattering in markets, these things start to have greater relevance, and they have to be part of the fund manager's toolkit. So that's where things are moving to now, I think. Maybe I'll be wrong and it will all revert once the war is hopefully over. But that's the direction of travel. It was easy to get a pass from your compliance officer, from the regulator, claim to be an ESG fund, by just cancelling the things that you couldn't really be bothered to do anyway because they never really perform that well.
I said it better. I mean, yeah, I mean, it's what I believe is probably a very contrarian opinion, certainly from what ranks so highly on ESG for many of the screening processes as well. I'm not sure if you didn't quite touch on it, but anyone looking through it and haven't screened will find that growth tends to rise to the top because it's a backward-looking process. Couple of questions. I know we are starting to get a bit pressed for time. We have a couple of questions. I'm going to bundle them all together here. About kind of your forward-looking views, and these are directed at two sectors in particular. You mentioned arms, weapon manufacturers coming back on the table as a potential buy. Specific, I mean, in the context of this, we're seeing record spending from Germany on arms across the whole of Europe, and also on the tech stock sell-off. Have some of these sort of graduated away because the sell-off has been so extreme earlier in the year, and even to this day, that they are now becoming more of like a value or core play? Are they entering your remit, companies that you would not have thought of before because their multiples are simply too high?
Yes. So arms defense, we don't own any in the fund. That's not to say we won't entertain it at all. And as you said, we do ESG in a way that we try to, first of all, we think about risk reward for our clients. And then we go, let's assess that company ourselves, check that we think their targets are ambitious enough, credible, ideally backed by the Science Based Targets Initiative. And does it align with, does it align with societal requirements in general? As I said, the big dislocation has been cancelling oil and gas in terms of cancelling Western companies, when actually we need that energy security. It's fair, I think, to say defence is back now. It's been neglected for a long time. It's back because ESG can now incorporate defence of liberal democracy, but it's also back because it's probably going to get earnings upgrades because of defence budgets being lifted. So that's defence. It's back in from the cold, I think. In terms of the tech sell-off, I think that's fair. I was being a little bit provocative by saying, tech is toast or unprofitable growth is toast. There are always exceptions. And there are a number of, maybe not specifically in the tech space, but there are a number of high multiple companies that have come down and started to come back onto our radar because they are, after all, let's say, good quality companies, or they do have good growth prospects. So yeah, that is core to our philosophy of being a blend agnostic fund. We will look at anything, but we always want to be comfortable that we're paying the right price for that asset or that cash flow stream.
Mm-hmm. And then I'm touching on the addition of gearing as well. Recent feather in the cap with the trust. What kind of companies then were you buying, utilizing that? Just so our listeners can have an idea about the actions you were taking in the recent market downturn.
Yeah, so when we deployed gearing, we did a couple of things. We entered a new stock about 3 weeks ago, actually a relatively defensive stock, Merck pharmaceutical stock, also another pharmaceutical or a medical technology company called Grifols. That probably accounted for, we're currently net geared about 5%, a touch less now because the market bounced yesterday. But we're just shy of 5% net geared. Maybe 2% of that was on those new entries that I mentioned. And then elsewhere, it's been that process, as I mentioned, of going, that's oversold. We're very comfortable with the outlook for that company. We meet the management teams every quarter. It's been unjustly punished. And examples of those stocks were Holcim, 10-11% free cash flow yield. Signify, 12 to 13% free cash flow yield when we bought it last week. Arkema, high single-digit free cash flow yield. Solvay chemicals company about the same on a valuation basis. So there were things that it was actually our cyclical value exposures that we felt had more than priced in European recession, and we're just getting sold off indiscriminately. And you know, it proved to be, at least from a tactical perspective, from today looking back to last week, it proved to be, you know, a good point at which to top up.
No, thank you. I'm also conscious of time. You've just gone over our allocated time. There are a couple of questions, unfortunately, I did not get to, so I do apologize with questions around sort of currency and more on the Ukraine. But thank you, Tom, for your presentation, and thank you all for joining. Our next presentation in 15 minutes will be BlackRock Sustainable American Income. So I hope to see you all there for that one. And otherwise, thank you everyone for joining, and I hope you all have a great day. And thank you as well, Tom, for the BlackRock Sustainable America. For anyone who wants to join and hasn't registered, you can do so by going onto our website. You can click through there on the advert for the event. Thank you, Tom, again, and thank you everyone for listening. Goodbye.
All the best. Thank you.